Hi, I'm James, and in this video, we're going to talk about what determines the value of a stock. Now, this is different to price because it's not just based on what people think it's worth, but based on the performance of the actual business. So in my previous video here, or wherever the link pops up, I talked about what determines the price of a stock and how the price of the stock is largely determined by investor sentiment, what people think it's actually worth. However, as we saw in March, and as we may see again in the future, I'm sure we will at some point, the price of the stock is not necessarily directly correlated to the actual performance of that company. When times are good, there's generally a strong correlation between the performance of a company and its price. However, when things get a bit questionable and dicey, aka Rona 2020, there can be a bit of a disconnect between the price and the actual underlying value of the company. Okay, so how do we determine the value of a stock? Now, there are many different approaches for this, but this is what I like to do. So I like to look at three things. One is the financial position of that company at a particular point in time. And this basically just tells us, how much money do they have in the bank, how much money do they owe, and sort of what's left over for investors. The second thing is, what's the profitability of the business? How good is that company at actually making profits? So, we might think some businesses, maybe some business that sells t-shirts, may not be as good at making money as another business that sells software to big high-end companies. Now, the third thing I like to look at is, where's the company spending its money? Is it investing in expanding? Is it taking on extra money through debt in order to fund its operations? How good is it at actually managing its cash? So these three things, for those of you who are familiar with accounting, these three things translate into the three financial statements that are made for companies every year. Now, the first one here refers to the balance sheet of the company, and that's where we can go to see this information about the company's current financial position. The second refers to the company's income statement, which basically tells us, how much money is flowing into the business minus the money that's flowing out of the business. And then finally, the third one here about the company spending refers to the business's cash flow statement. And this really focuses on where is the cash flowing at a bit more of a granular level than what we can see in the income statement. Okay, let's start with the balance sheet. The balance sheet is where we see how much money that the company has in terms of its cash. It shows us its assets in terms of, the equipment and property that it owns, all these types of things. It also shows us the liabilities. So it shows us where the company owes money, and that can be to staff, that can be to, banks and financial institutions that lend the business money, and certain other things like that. The balance sheet also shows us what's left over in terms of what's called owner's equity, what's left over for the owners of the business. So in this case, that's you and I as potential shareholders, assuming that we don't already own this stock. Now, some key ratios that we can look at relating to the balance sheet specifically, I'll just list off a few that I personally like to look at. So number one is the current ratio. And I've made a video on the current ratio, as you'll be able to see somewhere on the screen. And this one kind of tells us, how likely is the company to go bankrupt soon, which is basically based on how much money does the company have in cash right now in the short term, and how much money does it owe in the short term. The second ratio that I like to look at based on the balance sheet is the price to book ratio. Now, this gives us an indication at the share's current price, how much is that with respect to the actual money that's left over, if the company were to sell its assets off and then pay off its liabilities, the money that it owes, what's left over is what the shareholders are entitled to. And so the price to book ratio can give us an idea if we're buying this on a discount or not. The third ratio I like to look at is the debt to equity ratio. This basically just shows us, how much debt with respect to that owner's equity the company actually has. Now, in uncertain times like we're currently seeing in the market, with coronavirus, who knows what tomorrow's going to look like for businesses, really high levels of debt can actually be a very scary thing as an investor, particularly in an uncertain environment like we're seeing now. Now, if we look at these three ratios, just to give you an idea of what I look for this here. So I like to see a higher current ratio. I like to see a lower number for a price to book ratio. And I also like to see a lower number for the debt to equity ratio. Okay, so now we're going to talk about the profitability metrics. So this is with relation to the income statement. The income statement basically just shows us how much money comes into the door for the business through sales, and then minusing off all of the costs along the way, which can be, how much does it cost for the goods that we sell? What are our staff costs? What are our, other costs associated, like how much tax do we pay, and the interest on our loans, and that sort of thing. Now, different to the balance sheet, which is at a point in time, the income statement is over a period of time. So for example, we may be looking at the income statement for the whole financial year of 2020, or FY20 it's called. Now what this means is, for that whole period, for that entire 12 months, what were the total amounts of inflows into the business, less the total amount of outflows from the business. So some key ratios that we can look at that are derived from the financial statement, the income statement, are as follows. Number one, the PE ratio. Now this is the price to earnings ratio, and I've made a video on that, which I'll link up here. Number two is the gross margin, which basically says how much money comes in from sales minus the cost of the goods that we actually sold. And that's expressed as a percentage. The third is the operating margin, which basically takes it another step down the income statement to say, well, once we've subtracted off all of our operating expenses, what's that expressed as a percentage of our total sales? Now, fourth, the final ratio that I like to look at that's related to the income statement is the net profit margin, which is basically just telling us after the business has, paid all its expenses, it's paid its tax, it's paid its staff, all of those things, that final amount of money left over that the company takes in as profit, which is called net income, what is that as a percentage of the total amount of money that it made through sales? Because if you think about it, a business doesn't keep all of the money that it makes from sales. It might sell a t-shirt for $50, but it bought the t-shirt from a supplier for $20, and then it had to pay for the staff to sell the t-shirt, which cost another $5 per t-shirt. And so you can see that the net profit at the bottom, the net income, is different to that revenue, which is the top line of the financial statement, which is the top line of the income statement. Now, what I like to see is the following distribution of these ratios. I like to see a lower price to earnings ratio. I like to see higher gross margins, the bigger number, the better. Now these are expressed as percentages. So ideally I would love to see a gross margin of 80%. For an operating margin, I would love to see an operating margin of 60%, but the higher this value, the better. And finally, for the net profit margin, I would love to see a net profit margin of 20% or above. Now, these are very idealistic figures, but it just gives you an indication of sort of what these things are telling us and what good might look like. So finally, the third part of this entire picture is looking at the cash flow statement, which tells us where the business is spending its money and where the cash is actually moving at a more granular level than what we see in the income statement. Now, some key things here to note about the cash flow statement is it's broken up into three main sections, which is the operating activities, so day-to-day business activity expenditure, it's financing activities, and investing activities, although I may have got the order wrong. Now, there are a number of complicated cash flow statement ratios that I could go into, but I'm actually not going to for the purpose of this video. And instead, I'll just try to keep this as high level and as simple as possible. And I may make future videos on some of the ratios that we can look at with the cash flow statement. But what I personally do is I actually just glance the cash flow statement and I don't do too much analysis in terms of different ratios and things. Now, when I'm glancing the cash flow statement, there's something that's important to look out for. If we think about the cash flow statement, it's basically just showing us where the money is flowing in and out of the business. So that means that a positive number on the cash flow statement represents money coming into the business, and a negative number on the cash flow statement represents money flowing out of the business. So the key thing I like to do as I scroll down the cash flow statement is pay close attention to both the operating activities section and the financing activities section. And the reason this is it can give us an idea of how much money the business is actually using through acquiring new debt, or maybe it's issuing new shares to raise money to fund its operations, or maybe it's selling off some of its assets in order to cover some of its operating costs. Or even we might be able to see, well, is the business actually investing more cash into expanding, or is it selling off some of the stuff that it already owns? So what I do is, as I'm scrolling through, I drill into the financing activities part of the cash flow statement to have a look at, are there positive numbers here or negative numbers? Now, when it comes to the financing activities section of the cash flow statement, we want to see negative numbers here, because negative numbers means the business is paying out money for financing activities. But what that actually means is, generally that means the business is paying down some of its debt. Now, if I'm an owner of a business, I want to see a business paying down its debts. Whereas if we saw a positive number here, that may be indicating to us that the business is taking out more loans, and it's getting more cash directly in its bank account now, but that means that's long-term debt that it has to pay back in the future. Now, this is something that the Qantases of the world are doing currently, and a lot of the airline and travel industry stocks, because they're struggling. So they're taking on huge amounts of debt to bring cash in the door just to survive. But that's not really a good long-term sustainable way to run a profitable business. So if we also see a negative number in financing activities, that can also mean that the business is actually paying out dividends to shareholders. So if the company has made a good amount of net profit, as we talked about in the last part, well, the business can choose to pay out some or all of that cash in net profit to the shareholders as a dividend. And that will show up here in the cash flow statement under financing activities. Now, finally, when I look at the investing activities part of the cash flow statement, I also want to see negative numbers, because negative numbers in investing activities means the business is spending money on investing and expanding its business. So this could be, purchasing new machinery to produce more t-shirts, or it could be, buying a new facility to expand its operations into a different region. So, a negative number in this investing activities section can be an indication to us that the business is expanding its operations and it's looking to grow, which means it can grow our value as investors who own a piece of that company. And on the other hand, if we see a positive number here for investing activities, that can mean that the business is actually selling off some of its assets or investments in order to fund its operations. And that's not necessarily a good thing for us as investors. Okay, so to wrap this all up, there is a clear difference between the value of the stock and the company that sits underneath it from the actual price of the stock that's determined in the market by investors like you and me. And we can look at 3 key factors to determine what the value of that stock actually is. So we can look at 1, the financial position of the company, 2, the profitability of that company, and 3, the cash flows and expenditure of that company, how it manages the money that it makes. Okay, thank you for watching the video all the way through to the end. Give it a like if you enjoyed this video and you found it useful. And if you'd like to see anything in particular, you want me to dive into one of these areas or explain something, then please let me know in the comments what type of content you'd like to see going forward. Thank you, and I'll speak to you soon.